Alright, I am King Dubi and I've been able to mentor over 300 students to become profitable in trading. Built a community over 11.5k followers on X, and after doing over 15 payouts in prop firms and personal capital, I decided to do a very precise quality course that's going to teach you how to trade ICT concepts in a very simple way and pass your funding challenge with it this year. This course is very simple and there are no complications. All you have to do, watch it from the beginning to the end. Now, if you're already familiar with how to identify order blocks, breaker blocks, FVGs, and the rest, you have to skip to when I am using all of these concepts to form the profitable strategy you need. Let's get right into the video. What we have here is identify the 4-hour trend. Use the POI on the 4-hour. You are to wait for price to get into it or trade away from it. Look for a 1-hour POI mitigation before or during kill zone. And the last one is wait for a 15-minute market structure shift, enter and target closest opposite liquidity. So we're gonna go to the first thing, identify the 4-hour trend. For you to be able to identify the 4-hour trend, you have to understand market structure. So the first thing we have right here is market structure. We'll learn others yet, but let's focus on market structure. So what is market structure? Now the market is going to be in either of these phases each of the time. Either the market is trending to the upside, or the market is trending to the downside, or the market is ranging. Okay, when the market is ranging, it's neither going up or down. So when you are able to identify the trend on the 4 hours, then you have gotten almost 50% of the work done. So on the 4 hours, if the market is trending to the upside, you know you're only looking for buys. And the market is trending to the downside, you know you're only looking for sells. And you have to beware because the market structure changes each time. So the market can change from bearish to bullish anytime. And that's why we work with time and price. There is a certain time you come to the charts, and that certain time you come, you want to know the structure that is present at that time. Time and price is the only way to be profitable in this business. And we have time and price at a specific time. What is the market doing? So if you come to the market and you see something like this, are we still bullish? No, we have changed character. This is where price broke this low, have changed character. So you're going to treat that day as a bearish day because you have changed. Also, if you came to the market and you saw it trending down, and the moment you came, you saw something like this, it has shifted bullish, and you have to treat the market like a bullish market and look for laybys. That's it. So let's look at how this structure is on real life charts. Okay, so take a good look at GBP USD. You find out something was going on. The market was bearish all this way, then we went bullish, now we are bearish again. So it's a very simple way to understand it. This area is bearish, this area is bullish, this area is bearish. That's it. That's market structure for you. And how am I able to mark out this? It's just by marking the highs and lows on the chart. So if I want to start marking from here, I'm gonna do this. This is a downtrend, so we are breaking lows back to back. We are breaking lows back to back, and our highs are protected. And then when you realize that the first protected high was taken out, that's when we shifted bullish. And then we retraced. Watch the dip. After we took out this, watch the deep retracement. We did this one first, and then we tried to go up again and we retrace deeper. That shows you that this is a low that led price to break this high again. Seeing what price is doing. So we have this high here, watch, and then we have this change of character here. Now we are going back bearish because when we did this, we pulled back. Now we did this, now we pulled back. This is how the bearishness changed. And then we have this, you get, and then we have this, you get, and then we have this, and then we have this, and then we have this, and then we have this. Did you see that? How the market was what? Bearish. Where is the change of character? This, we shifted bullish, and then we shifted bearish again. This is the change of character here. We're bearish all along. Now, let's move to the next step. POI selection. So when it comes to POI selection, you have to be extremely careful and smart, because when the market is bullish, you want to only use bullish POIs, and when the market is bearish, you want to only use bearish POIs. Okay, so what are the kind of POIs I use? Now, the kind of POIs I use are these. Now, some ICT students call it POI, some call it PDRA, but they're the same thing. So we have fair value gap, we have order blocks, we have liquidity, we have breaker blocks, we have rejection blocks. So let's start from what? Fair value gaps. So a typical fair value gap looks like this. Now, this is a gap we have on the candle, right? And the gap, it, on a normal day, candles don't leave gaps. Just take out how everything is clustered here. Yeah, candles don't leave gap. But when they are weird as gaps like this, it's fair value gap. We have this gap too, it's a fair value gap. So a fair value gap always consists of three candles. The main candle that is carrying the gap, the candle before it, and the candle after it. So what's the role the candle before it and candle after it's playing? So the close, or no, the low, okay, of the candle before the main candle, and the high of the candle after it. The low of the candle before the main candle and the high of the candle after it. That boundary, that's how we are drawing our box between this and this. They have a fair value gap. So it's a point of interest, guys. Okay? Or a PDRA, whatever you call it. It's an important place in the market. And we have it on bullish candles or bearish candles, regardless, any of them are still fair value gaps, right? So we have this one too. You see it. The boundary started at the what? The low of this candle and the high of this candle, and this black candle is the main one carrying the gap. See my rectangle between that boundary. All right, an example of a bullish fair value gap. We have this one here, this one here. You see that? It's found on the bullish candle, right? So this is the main candle with the gap. The candle before it, the high of it, and the candle after it, the low of it. That's the boundary I used to mark the box. One last example on a bullish candle. We have this one here, and what we see here is this is the main candle, the candle before it's high, and the candle after it's low, period. Do you see that? Now that's it. All right, so we move to the next, which is order blocks. Order blocks are simple. I have my way of definition of order blocks, and order blocks is just the last smallest candle before a drop for a bearish order block, and a bullish order block is the last candle before a push to the upside, right? So this is what we have as a bullish order block here. Sorry, a bearish order block, because the last smallest candle before the drop. Do you see that right here? That's it. That's my OB. That's my OB. OBs are extremely easy to find. See another one here. That's my OB, the last candle before the drop. Now it has to be at the origin. I like it at the origin more, but sometimes you might get, now this is regardless of color. All I want to see is the origin of this bearish drop. Where is the origin? Here. Between these two candles, which one has the smallest body? This one. So I'll start drawing it from this small one and extend it to the top. That is my own way of drawing my order blocks, okay? So yep, I have that right there. That's an OB. And then this is an OB also. This is an OB also. I draw it from the beginning, I extend it to the ending. That's where an OB is already. That's a bullish order block, because what? It's a bullish trend, right? What else again? You can find another one here again. Oh no, you can find another order block here again. You see that, right? So let's look at another POI. So we have liquidity. So liquidity is basically highs and lows in the market. Nothing too serious. So we have all the random highs and lows we have are all liquidities, right? Every high and low you see are liquidity pools, right? And I'll tell you how to differentiate between a break of structure and a liquidity. As you can see, all these highs and lows. The highs are called buy side liquidities, and the lows are called sell side liquidities. Okay, that's just it. So low, all these lows are sell side, all these buy highs are buy side, right? So don't think of it too complicated. Now I'll tell you the difference between a breakout structure and liquidity pool. So for instance, what I'm trying to show you right here is this. Now when you have the market moving like this, of course you know that the market is never straightforward. The market is gives a lot of zigzags. Now, we know that this is a high, this is a low, this is a higher high, this is higher than previous high, and this is the higher low. This is a protected low that if this low takes out, the market has shifted bearish. The same thing with this. This is a higher high, higher than this one, and this low is the lower, is a higher low. And is this one that if price comes and take out, price has shifted bearish. So what about all these lows? What about all these lows that are not protected lows? This is where I call them liquidity pools, because the market can come back and take them out and still continue higher, and we will not call it that shifted bearish. But if the market comes and take out this one, we'll say, oh, we have shifted bearish. Do you get it? So all those ones that if price takes out, it doesn't shift bearish, is my liquidity pools, and these are sell side liquidities because they're lows, right? Same thing with this, same thing with this. This is protected. I don't need it to get taken out. If it get taken out, you have shifted bearish. So this is where I get my liquidities, right? That's how I use them. That's exactly how I use them, right? So let's go back on charts. So now the next POI is breaker blocks. Now breaker blocks are other blocks that has failed before. It's just that simple. Other blocks that have failed before is what we call breaker blocks. Other blocks that have failed before. Now take a good look at what's happening here. We have a breaker structure. This is a bullish trend. We have a breaker structure here. We are going higher and higher, right? Now, for all of this breaker structure, we have what? Other blocks being mitigated. Now we have this other block here. Okay, we have this other block here. If I extend this right here, do you notice what happened? Now when the market shifted bearish and started coming down, this old order block now serves as a POI, and that's what we call it breaker. Yep, you can see how price got back to touch it and reacted. Okay, that's a breaker. When an order block has been filled before, price normally comes back to respect it as a breaker. All right, another good example, this market was bearish all the way back down, but then it flipped bullish at some point. All right, it flipped bullish at some point. And how it flipped bullish was here. So as you can see, price did this. Now if I extend this to the extreme right, what am I doing? You find out that price came back to it once, twice, third time, and then dropped. It is respected as a breaker block. That's just how they are treated when an order block has failed before, price comes back to it. And likewise, supply zones, bearish order blocks, right? So if the market is bearish like this, and this was a supply, for instance, this was a supply, what happened is when the market goes up this way and comes back to touch it, it treats it as a POI to go higher. That's also a breaker. Okay, we'll call this a bullish breaker. We'll call this other one a bearish breaker because it pulls prices to go down. It's a bullish breaker because it pulls prices to. All right, so the next is rejection blocks, right? So rejection blocks. So when you take a look at these markets, we find out that we have lots of rejection blocks here, and I'm going to show you how they look like. Now, this is a clear example of rejection block. We have it right here. Did you see that? That's a rejection block. Did you see that? Good. It's standing on its own. Now, this is a week in the market, a week around where an order block should be, which is at origin. Okay, at origin, see where it is, and there is no candle in front of it. No wick is in front of it. No candle is in front of it. That means it's a rejection block no because no wick in front of it and no candle in front of it. Now, that's a bearish rejection block, and we also have bullish rejection blocks. I think I'll give you an example of one. So let's just look for, okay, this is another bearish rejection block, right? See it? Now when price comes back to it, it gets mitigated, right? And then price reacts from it, just like what you see right here. Now I'll show you bullish rejection blocks. I would have called this one, but you see candles are in front of it. I would have said is this one, but you see candles are in front of it. So this is the best example I can give right here. See this? This is clean. This is very clean. This is a bullish rejection block, right? And some of you are asking, I know some of you will ask, you don't need a BOS to confirm that. Just like an order block now, you need a BOS to confirm that it's a valid one. Get is a break of structure here. It's always what we use to confirm to know if an order block is valid to trade. If it doesn't have a break of structure, we don't consider that, for those of you that don't know. But then this completely, as you can see, this, this for a rejection block, we don't need this. If it's here, okay, fine. If it's not there, okay, fine. Because if it's not there, our rejection block is still clear, it's still valid. If it's not there, like if there is no break or structure, our rejection block is still valid. Just like this one has a break or structure actually, yeah. But there are some of them that don't, and it's still valid. That's my point. So now let's move to the next. So the next we're going to be talking about is Killzone. Now, Killzone is the time we come to the chat. I've told you guys this since countless times that if you're in the chat round the clock, you would lose money almost every time. Because like I said, the market is always changing structure. And if you're always in the chat, you find it changing structure back to back and you get involved and you lose money. You'll be in a trade when it's changing structure. So always use Killzones, which is the specific time you should come to the chart. Now, when you're trading this strategy, set your time to UTC -5, New York time. I don't care where you stay around in the world, Nigeria, Ghana, Kenya, US, UK, everywhere you are, set your time to UTC -5. Why? So that you can work with these time settings I'm giving you and not get confused. So Killzone, you can trade the London Killzone, you can trade the New York Killzone, anyone you like. I trade the New York Killzone. You can trade one. I won't recommend you trade the both because you stay on charts a long time and you're exposing yourself to much risk. So London Q zone is 2 a.m. Eastern time to 5 a.m. Eastern time. Like this is the time you need to be executing. So to prepare for this session, you have to be on chart 1 hour before that time. That's it. Because this is the time you need to be executing. Now, New York Q zone is literally 7 a.m. to 11 a.m. Eastern time. So it means you have to be on chat as early as 6 a.m. Eastern time. Here you have to be on chat as early as 1 a.m. Eastern time so that you can plan ahead and analyze your chart and know what you're looking for so that you don't come and start rushing. But this is your execution time. Between this time to this time, you can place a trade. Now let's move forward towards our entry and exit. I said enter with 15 minutes market structure shift and exit at closest 1 hour buy side liquidity. So now let's look at a very clear example on how to use the strategy. We have talked about every other thing except. So now we're gonna put everything together. We're gonna put everything together. You have been able to learn structure. You've been able to learn POI, how to see them, and now you have also learned Q zones as when to trade, and you're also seen the entry. Now we're gonna put everything together, and I'm gonna show you how to find trades, get into trades, and everything. When to get in, when to get out. So here we go. Now, what do you see? This is a bearish trend we are in on GBP USD. Aren't you on a bearish trend? Good. So the next thing, after you've been able to know that you're in a bearish trend, the next thing is what POI can we trade from? That's what you ask yourself next. What point of interest can we trade from? So when you don't know the point of interest trade from, that's where the problem is. So as you can see, anyone at all. So we have order block here. That's where price got into. And one thing I need you to know about structure and POI selection is this. For example, if you're in an uptrend, you only need POIs in this new swing. We call it dealing range. You only need POIs here. You don't want to trade POIs here, because if price comes back to take a POI here, you've shifted bearish because you took out this low that's protected. So you want to only look for POIs on this swing to go higher. That's what you want to do, right? And also understand that it could take days for price to come back to a POI, and you have to be patient. And also understand that after it has taken days to come here, it can also take days to get here, because the market is ranging and there's poor volume. And when this kind of thing happens, listen, every single day you're just applying the entry model, because you have been able to anchor here. You're not going to look for fresh 4-hour POIs again. It has happened. We are now on the way to this place. So no matter how it delays, the same thing with a bearish trend. So if you have price going this way, okay, what happens is that you want to make sure you're looking for, when you are in this swing, you're looking for only POIs like that. And then once you break out, you don't need any POI here again. You need POIs here and there. That's just how it is. So getting back to the main issue. We are going to take this POI, for instance, this particular dealing range. Now, when we are working with this POI, I'm trying to show you what transpired around this whole place. Okay, everything that transpired in this range before we got out. Okay, that's it. So the same thing, you see, this is an FVG also. When price mitigated it, every activity that played out before it got out, this is when the range expired. We entered a new one. Okay, so as you can see, every low, look at it here: high, low, high, low, change of character. So we have to work with only a POI that is found in this new range as at this time. After getting your entry, once you break out, you need a new POI. That's my point. I know why I'm saying this over and over again. Okay, that's my point. And look at when price broke out here, for instance. Look at when price broke out from here. What did you notice? Price here was retracing. What do you think it retraced to? Look at it here. Buy side liquidity. I told you guys when I was teaching liquidity that liquidities are not protected highs in a bearish trend. Now this is a bearish trend. This high is protected because it's this high that led to what, this break of this low to create this low. This high created this low. Now we've traced inside the other block, and now all the way from the other block we got here. Where is the high responsible for it? Here. So this high is protected. So if we break this high, we become bullish. So it means every other high here are just normal buy side liquidities that are POIs, except this one. So that's why as price took out this, price went to take out this as a POI to drop. Now as it drops, we have gone out of this range. We are now in a new range, which is this low. Okay, this high is what led to this low. So it means we would only work with POIs around here. Okay, as you can see, we have another FVG here. You can see how price reacted to the FVG. Then you now see the drop. Are you seeing this? And now as it dropped and broke here, we now need a new POI here. A new POI, which is this FVG here. And price reacted from it and it dropped. And now we're in this range. I want to actually specifically talk about, because there were a lot of opportunities in this range till we broke out of here. Okay, so let's go to the 1 hour time frame, because what's the next step? Let's go to our checklist again. What is our checklist saying? Our checklist said identify the 4-hour trend we've just done. We are bearish. Choose a POI on the 4-hour. You have to wait for price to get into it or trade away from it. So this is the POI we've chosen, order block. And the idea is this: if the market has not traded into it yet, you wait for it to happen. If it doesn't happen in your session, you go home. When your session is over, come the next day. But if you come and it's already in a 4-hour POI, then fine, you're good to trade. So it's either you wait for it to get into it or you're trading out of it. But that's the case here. This is the POI order block. We have actually mitigated it. And some people be like, but you said order block is the smallest candle before we drop. Take a look at this whole zone. If you check, you find out that this candle is supposed to be the smallest, but is it at the origin? No, it's not at the origin. So all you do is you can start drawing from this candle, but make sure you extend it to the origin. Always make sure the origin is all summed into the box. Makes more sense, right? So that is what we are going to talk about. This particular POI we have mitigated. So say look for a 1 hour POI mitigation before or during Killzone. Now let's get to work. 1 hour POI. So it means in as much as before we got out of this particular range, it took us some days. So you see my session breaks on, turn it on in your own, right? Look at it here. You click on session breaks, every single day on your chart will be demarcated, right? So it means we started from Friday 20th December. That's when price entered this order block. So we're there 1 2 3 4 5 6 7 8 before price broke out of the range. So 8 days of looking for only bearish opportunities, because we are bearish. One, we are operating from this one POI. Two, and also in as much as we have not gotten to this red line, every single day we come, we are looking for only bear trade, clean, no matter how long it stays in this range. It's looking at bear trades. Okay, so let's go to the 1 hour chart now. So I have my indicators set. The indicators that shows me Asian, that showed me London, and that showed me New York Killzone. I have it set. If you want to set the same, cool. What's the name? The name is Asian Session Range. Okay, so I'll just go to my indicators and show you how it is. Asian Session Range, FXN Asian Session Range. And if we're going to talk about the settings, so let's talk about the settings so you can set the same and use the same, since this is the course, right? So set the same and use the same. So this is the input I have. You can screenshot this to this place, London start minute. Take a screenshot, and then from London start minute, look at it, take the screenshot of the remaining place. Stop at New York box line with, and from here take another screenshot. We stop at last week line with. Okay, take the screenshot of this remaining settings. Now this is my style I use. My Asian is yellow. All of these are does not have any color. Okay, 000. So my Asian is yellow, my London is blue, and my New York is red or pink. I don't know how I call it. Then labels and lines all unchecked. Visibility visible on all time frames. Okay, right, that's the settings for you. Please, this settings is not going to, is this indicator, it does not work accurately on indices, just in case, just Forex. So now we have this particular day. This is the Friday 20th. As you can see, during our London, which is the blue side, can you see that we are not at the 4 hour POI? This is the 4 hour POI, the big side, right? Then during the New York, we are not there yet. I told you guys, if you are not there, don't trade. If you're not there in your session, don't trade. After your session, you leave, come the next day. So coming the next day, we have entered previous night, I think here. So we have entered the next day. Let me set my time to -5 also, so that you guys don't get confused. But honestly, I use +1 because I stay in West Africa, but I still understand the time is just, I know the equivalent time in Nigeria here. So listen, this is the Asian session. We don't trade in. Now trade the what? London. So those of you trading in London, so how are you going to trade this day? He said look for a 1 hour POI before or after Killzone. 1 hour POI. So what do we have here? We have fair value gap that happened during the Asian. Did you see that? But it's not even only what happened. Price also broke structure here. So it means after that break of structure, there is a POI somewhere. We have both bearish rejection block here and other block. So I'll just mark everything together, and you see how price got into it during London. Do you see that? So it means we'll look for our entry, which is the next step. Let's go and look at it. Next step says after doing that, wait for a 15 minutes market structure shift, enter and target closest, opposite, liquidity. As simple as that. So I'm never going to go right deep into that for now so I don't get crowded, but I'll just show you where we are gonna exit. Okay, so if I was gonna trade London, since we said closest 1 hour target, which is here, I'm gonna be trying to exit at this point at most, because here is kind of far, right? So it means during the London, this is where I would have exited. So about the 15 minutes POI, don't worry, we'll talk about it when we'll come back. We'll go to the 15 minutes time frame. But for now, we'll talk about other days so they can see how it works. So you see 1 hour POI respected and price dropped to target for that day is gone. Now if you come to the New York Killzone, which is this pink side, do you see that it's the same thing we did? 1 hour POI on the 1 hour chart. Do you see that? 1 hour POI, and then you see the drop, and they said target closest 1 hour buy side liquidity. Now this is like the closest 1 hour buy side liquidity. If this day is very very volatile, like if this day had lots of volume, trust me, we will be hitting here, but we didn't. So most times we go far, but there was poor volume in the market today. So should we check 15 minutes? Let's go and check 15 minutes for this particular day. So now this is the 15 minutes time frame. Now when you hear me say 15 minutes market structure shift, okay, now this, whenever you see me say something like this, now you need to understand something, that if the 15 minutes is already aligned with the current trend, when you came to meet it, you don't need a new market structure shift. You just need to enter your trades from that particular zone, but you might confirm it with something like a 3 minutes market structure shift. I don't know if I'm clear. So what I mean is 15 minutes market structure shift is when price enters a 1 hour POI, but then the structure is bullish. Let's say we just enter the 1 hour POI like this, and the 15 minutes is looking bullish like this. Now you would need price to flip bearish before you get in, because you want, the idea is that you want all the time frames to align. 1 hour is bearish, you want 15 minutes to be bearish too before you take a trade, or else get clapped. So that's exactly what I mean when I said market structure shift 15 minutes. It has to be in line. Now this guy is already bearish. 15 minutes already bearish. You can see we had this low, we had break of structure, we turn back, we are still bearish. So we don't need a new chalk. All you need is a 3 minutes confirmation around here, or you can enter directly, but I think in 3 minutes will make you see. All right, so we have a 3 minutes structure shift here. Did you see that? And return back to something. So personally, if I have that 3 minutes market structure shift, I would enter at the close of the candle that did it, right? I need a short position. I enter the close of the candle that did it. So we have I'll keep my stop loss above here, very very important, above the whole zone, very important. Now this is where I'm going to plan to enter, but the only thing that can make me shift my entry higher is this. So from there to where I'm to exit at, of course this is the 1 hour area where we are to exit. If I calculate it and it does not give me 2 arrow, what I'll do is, before this candle finish forming, or while it finish forming, I'm going to keep calculating this. If I see that it's not going to give me, then I'll make sure I don't enter there, and I'll shift my entry a bit higher, so that after this candle close, the next candle that will just trade a bit back up will tag me in. Now why am I doing this? A lot of other traders will tell you you have to wait for price to get into an FVG or something before drop. Listen, it doesn't do that every time. And if you follow that principle, you miss a lot of trades that are just going to create this and drop. So you want to plan to enter here. The only thing that can make you reduce your entry bit is from where you enter and your stop loss, and where your what target is. That's exactly what you want to make sure it's 2R. If it's not 2R, you're not taking the trade. As simple as that. So it means you're already going to define your targets and your exits, everything, before you even place that trade. And that was going to determine where your entry will be, so you can get the RR you want. So that's set. Let's see the next example. Let's see what New York did. So this is the 1 hour period I've talked about, and again, as you can see, the 15 minutes is still maintaining the same bearish trend before we got here. The 15 minutes did not shift bullish while getting here. It maintained it, created this low, we retraced back. So therefore, we just need a 3 minutes confirmation to get in from there, and then target this low. That's for the New York guys. Alright, so this is the 3 minutes time frame, and this is the first time we tapped into it, and when we did this, we did this, we did this, we did this, and all those other. So this is exactly where we had our what shift in market structure. Okay, now there are cases like this. What I do is there are cases like this, and now there are two types of structure shifts. Now if your structure shifts happen to be like this, because it means the market was in a bullish trend before we got to POI, right? On a bullish trend before we got to POI. Now, if it's this kind of pattern, if price had to do this, it means you can set your what? A sell stop here. Now, why? Because if this low is protected, and if this low gets broken, it means it has shifted bearish, and you want to be in that bearish momentum as it's going up. This pattern is not recommended if the market structure shift is like this. If the market structure shift is like this, something like this then happens, because a lot of times this happens when it touches here, it moves back, and now this is just a low, and if price breaks below, I'll take the trade. If breaks it and close below, yes, I'm going to take the trade. But if it's this place, we can put a sell stop. Now, the only thing that can make me not put a sell stop are there if from the sell stop and my stop loss to where my target is not going to give me a 2R. If that's not going to happen, I'm not going to use this. Now, I explained this in my video that talked about if you normally miss entry, watch this. I think I did a video about that. Go and watch that video. You understand how I enter my trades so that I don't get left out. Okay, but this is a short explanation on that. So here I'm going to enter with a sell stop here, and then put my stop loss here. And if from there to where my target is, you know, I'm going to set the entry here to calculate it for before price ever triggers me in. And if it's not going to give me a 2R, what I'm going to do is I'm going to what? Not enter with a sell stop. Rather, I will shift my entry here, and maybe it's going to be with a limit here, so that while price purges here, any little retracement will tag me in to give you my 2R. Now, this is a hack that I've not seen any trader use. This hack will help you not miss out on trades, will give you your clean RR, and will help you not hold trade and price. You can imagine you entered, you know, based on when price closed bearish, maybe you entered here, you put your stop loss here, and you are not expecting your TP to be down just to give you your 2R. Have you realized that price will reverse on you? So this particular technique is going to help you not have issues of price get close to TP and then reverse on you, know, because you're exiting at a very high value area, and you're squeezing out the market to give you that 2R regardless. It's the smartest thing you will ever do. So learn. Now we back on the 1 hour chart for another day's opportunity. We have seen the first day, we've traded it, New York and London gave money. Now the next opportunity is this. So as you can see, we are still holding to this 4 hour POI, and on the 4 hour we have not gotten to this target yet. So every single time you come, you still apply the same logic. You don't need a new 4 hour POI to find, because we have not gotten to destination yet on the 4 hours. We are still on the way. It's a ranging market, and as I chose this example, so you can test as much as possible the entry model, so you can see. So now we have this literally here. We have our 1 hour POI here. So now that 1 hour POI, as price got into it, when did price get into it? So first things first, let's act like we have not seen the whole idea, because in London session, which is my blue area, we have done a sweep, and I told you guys liquidity is POI, so we have done a sweep on the 1 hour. So let's see if we can get an entry, if we did get an entry or something. And you know, if I was the one, if I was seeing this market, like what's the rule? The closest, what, 1 hour opposite liquidity is going to be the target. So we actually did this and met target, but then let's see if the 15 minutes would have permitted us to enter the trade. Okay, so like I told you guys before, this is where the 15-minute market to shift is very effective. So as you can see, the market on the 15 was on a bullish trend until this sweep happened, which is what we call uh, this is what we call our normal 1 hour our 1 hour liquidity purge, our 1 hour liquidity sweep. This is when it happened. It happened in London, and therefore it was in a bullish trend when it happened. So we need that change in structure, okay, before we can take it seriously. That's just the truth. So if this was the low that led to this high, and this low led to this high, did we really have that sweep during London? Did we really have that change of character during London? No, we didn't, because this is exactly where the change is going to happen. And I would have considered this one, but after this I would have considered this as a change, but price did not close below. Let's verify. Did price close below this low? It did not. So that's why I cannot enter. It did not close below. If not, I would have taken that as what, as this kind of sweep, sorry, as this kind of market structure shift I told you guys about, whereby this is the low that led to the high, but then price decided not to take out this one, but take out this one and close below. I can still take a trade like that, but not with a sell stop. Never with a sell stop. And when this one later happened, session was over. I see the blue side was over before it happened. So that's why there was no trade in London. So in New York, was there a trade? Something like that. Yes, there was. So as you can see, the markets kept trending higher, higher high, higher low, higher high, higher low. Then we had this high. So entering this 1 hour POI during New York session, what will I do? In as much as this is the low that led to this high, I'll put my sell stop there to see if it can get invalidated, if its price can get there. And where will my TP be? They said closest place on the 1 hour chart, which should be here. Should be around here or around here. Did it give me a 2 arrow if I'm going to put my entry there? No, it won't give me a 2 arrow, right? Let's think about it. It won't give us a 2 arrow. So what will give us a 2 arrow if we push a bit further? Now, this is where price would get to give us a 2 arrow. Can you see that we don't have an entry? Because when price came all the way back down, took out this, it did some small candlestick retracement like this, but we couldn't get in. So that was how we missed this trade. Okay, so I will just go to the 1 hour chart. Can you guys see? We have had a nice trade, but no trade today. We missed the New York entry. So it's like that sometimes. So this is the next day. This is the next day. We are on the 1 hour chart. Did we have an entry? So let's take a look at that. So during the New York London session, what do we see? Price getting into that. Do you see that? Price gets into a 1 hour POI, which is beautiful, very beautiful. So what should we do with that? Let's go to the 15 minutes. Now this is when price got into that POI, right? Okay, this is when price got into that POI, and you can see that after when price got into that, the session was over, so we can't take advantage of that. Do you see? We can't take advantage of that. So the next time we can try that is New York. So let's see. And if you're trading both sessions, I won't still recommend that. If your session did not give you money, wait till the next day. Because if you're trading both sessions, it looks good based on idea, but it's gonna stress you out because you'll be on charts most of the time, and that's not cool. Alright, so now New York, this is New York time, this pink area. So New York went to this OB. Look at it, we had the breaker structure. This candlestick retraced to the OB. So let's see if we have an entry. And if we have an entry, where are we going to be exiting? Closest 1 hour opposite liquidity. I think here is the best place to exit. But let's see how it's going to be. Okay, you see right here, that's the 1 hour OB, and you can see that the 15 is already in a bearish trend when price retraced into that. So we don't need a 15-minute chalk anymore. We need a 3-minute chalk to get. All right, so this is exactly where everything gets sweet. So we tapped here, we moved. Now if we want to follow the exact place that 3 minutes change character, this is where we're going to be entering from, and you see that's really far from there and too close to our target. So we're going to use our head. So we had our first low here, we pulled back, and then we had price do this, which is exactly the same kind of point of interest I say, same kind of break of structure or market structure shift I said, whereby after price entered the POI, we'll have something like this and then pull back and then something like this. And I told you if this closes below this low, you're gonna get in. And that's what happened here. This candle closes below this low. And let's see, we'll try to calculate if we'd have our 2R doing that. Okay. Let's see if we have our 2R doing that. Now this blue line is our target. Right there is our target. So what's next? Did he give us? It's never give us 2R. So let's take it further if it's going to give us up to 2R. Okay. So it means once I check my entry, sorry, my TP, that's my target, and my exit, then this is where I'm supposed to enter. But then it doesn't give an arrow, so I will shift my entry and leave it at this point. Why? I'm just hoping that if price range, and then finally gets to where my entry is, I'll be triggered. That's is me trading on hope. Yeah, hope, not trying to force direction, but for entry, because I want to exit at the right place and I want to keep my stop loss at the safest place and I want to get a good RR. So there'll be times when price would not get to that entry, yeah, and it will leave you. Don't chase, wait to the next day. You need discipline to trade this strategy, and you know, of course, you're going to make plenty of money from it. I've come to the end of this video. So the mentorship is open, and in the mentorship you're going to learn more about how to trade this style and so many other deeper information that you would need to trade this style very profitably. So in the mentorship you would learn this strategy even on a deeper level, and you'll be able to get the direction right almost every time, and you learn other entry models that work when these entry models are not available. And I've been getting DMs recently about what prop firm I use. I use other prop firms, but I think Tentrade is one of the best amongst them. Yeah, because of the instant funding. You don't need challenge, although they have the evaluation part, but the instant funding is the most popular in Tentrade. All you just have to do is buy the account and know the rules, okay, and stick to it. So now the link to register for Tentrades is in the description. But even before you want to register, if you want to have inquiries about how Tentrades work, their rules, you want to have it in PDF so that you can know what you're doing, then you can send me a direct message on Telegram. The first link in the description is a DM to my Telegram. Is a link to my Telegram DM. Yes. And you can ask me questions about the mentorship. You can ask me questions about the funding I use. You can ask me questions about basically anything. And I'm going to help you. We're going to chat. Okay. Click on the first link in the description. So if you enjoyed this video, you know what to do. Like and subscribe and share. See you guys in the next video.